Welcome back to the deep dive. Today we are taking a deep breath and plunging right into the global uranium and nuclear industry.
We are.
Because this sector is flashing some really conflicting signals right now. We've got a stack of sources here detailing market shifts, some huge policy changes, and honestly, some pretty big strategic risks that are looming here in mid-November 2025.
Yeah, and you might think it's just a straightforward boom market, but it's not.
No, not at all. Our sources show it's actually a landscape of sharp and I think necessary contradictions.
That's the perfect way to frame it. I mean, we're looking at a strategic environment where national energy security, geopolitical competition, that's all driving demand. But the real story, the economics of it, is this structural tightening of the physical supply chain.
So what's our mission today?
Our mission is to find those little nuggets that explain this paradox. How can a sector feel like it's destined for this massive growth, but at the same time shows so much daily volatility and these persistent operational hurdles?
And we see that core tension right there in the data. On November 14th, 2025, the spot price for U3O8, that's your standard yellow cake, it settled at $77.20 per pound.
Right, which was a modest dip recently.
Exactly. On the surface, that doesn't scream market euphoria, but the long-term story our sources are telling is, well, it's completely different.
That short-term softness,
Yeah.
it masks a really powerful and non-negotiable structural reality. It's what's driving that long-term bullish outlook.
Okay, so lay it out for us. What's the reality?
We estimate that annual reactor demand worldwide is sitting at around 180 million pounds of U3O8.
180 million. And how much is the world actually producing?
That's the problem. Global primary mine production is lagging badly. It's stuck at only about 130 million pounds a year.
Wow. So you just do the math right there.
You do the math. That's a persistent deficit of 50 million pounds.
50 million. That's what percentage is that?
That's about 28% of global needs. And this shortfall, it isn't temporary. It's expected to hold through at least 2026.
So the market has to be drawing down inventories.
It has no choice. It has to. And that creates this immense pressure further out on the curve.
So, okay, if the deficit is 28% and it's undeniable, why hasn't the spot price just blown past $100 already? What's keeping the lid on?
It really comes down to short-term trading inventory and just the natural lag between a commodity hitting its deficit and the utilities needing to sign those big long-term contracts.
Spot trading can be pushed around by small inventory releases.
Exactly. But if you want to know what the truly informed players believe, we're talking the utilities, the long-term funds, you have to look past the spot price. You have to look at the futures market.
Which brings us to contango. This is our key indicator of market confidence, right?
It is.
For anyone who doesn't know, this is the situation where the price for future delivery is higher than the immediate spot price. And our sources show the market is aggressively paying up for that future certainty.
Absolutely. Just look at the numbers from November 14th. The contract for July 2026 delivery is at $80.25.
Okay, so that's already a premium to the spot price.
A decent premium, but then you look out to April 2027, and that contract settles way higher at $84.15 per pound.
That's a $7 premium from today's spot to the 2027 contract. That's significant. So in practical terms, what does that contango structure tell you?
It tells you the market is fundamentally upwardly sloped, and that is a huge sign of long-term scarcity. Utilities are paying that premium to lock in supply for 2027 because they know that 50 million pound deficit is real.
So they're betting on scarcity.
They're not even betting. They are affirming their conviction in it, no matter if some trader sells off a few tons of yellow cake next week and pushes the daily price down for a moment.
And that scarcity is definitely being reinforced by these ongoing production struggles we're seeing. I mean, bringing new supply online is just hard, it's slow, and it's really expensive.
It is.
We saw Cameco, a huge producer, recently cut its 2025 forecast for its McArthur River and Key Lake facilities. They're now down to 14 to 15 million pounds from a target of 18 million.
And you see similar constraints from the other majors. Kazatomprom, the big state-backed producer in Kazakhstan, they're sticking to their constrained volume of 13,000 to 14,000 tons of uranium for 2025.
Which is, what, around 36 million pounds?
Roughly, yeah. The key takeaway is that the big players are really struggling to meet, let alone increase, their targets.
And this production problem, it feeds directly into corporate performance, doesn't it? We saw companies like Cameco and UEC, Uranium Energy Corp, report solid revenue, but investors got spooked because they missed their profitability forecasts.
Precisely. And this highlights the second major challenge, rising operating costs. Inflation, labor, the huge capital cost for restarting mines.
Mhm.
It's all eating into the gains from the high commodity price.
So they're getting more per pound, but it costs them way more to get that pound out of the ground.
Exactly, and that means lower than expected margins.
Okay, let's pivot from the supply side over to policy, especially here in the U.S. The government is really trying to jumpstart its domestic supply chain.
It is.
And the biggest signal we've seen recently was the official reinstatement of uranium as a U.S. critical mineral by the USGS. That's the first time it's been on that list since 2018.
This is a huge policy move. I mean, you have to remember the U.S. currently imports over 95% of its uranium.
95%.
So that designation, it acts as this powerful strategic catalyst. It unlocks several critical benefits for the domestic industry.
So how does being on a list actually translate to action on the ground for, say, a mining company?
Okay, first, and this is maybe the most important, it gives the entire sector elevated strategic importance. It's a national security asset now. That means political will.
Right.
Second, it accelerates permitting. Projects can now be prioritized under things like the Earth MRI initiative. They basically get to jump the queue. And third, and this is the most tangible part, it grants access to federal investment.
Money.
Domestic projects are now eligible for support through programs like the DOE's Critical Minerals Accelerator, which can offer up to $50 million per project.
And this isn't just theory. We have a perfect, tangible example of this working right now. Anfield Energy just broke ground at the Velvetwood Uranium Vanadium Mine in Utah.
And they're targeting first production by 2026.
But the crucial detail here is the speed of the approval.
This was the very first project approved under this new accelerated process. The Bureau of Land Management, the BLM, completed its entire review in a highly condensed 14-day window.
Wait, hold on. 14 days. 4.
14 days.
If you have ever dealt with federal permitting, you know that 14 days is less time than it takes to get the application logged in the system. That is astonishing. It really shows the government is laser focused here.
It's a huge deal. It shows the policy mandate is finally translating into bureaucratic urgency, which is historically unheard of in this sector.
Right.
But the progress isn't just limited to digging stuff out of the ground. We're also seeing big strides in the advanced fuel cycle, specifically the infrastructure for HALEU, high-assay, low-enriched uranium.
And for listeners who don't know, why is HALEU so important? Why can't these new reactors just use the regular fuel?
Well, traditional reactors use low-enriched uranium, LEU, which is about 3.5% enriched. But this new generation of advanced reactors, your microreactors, your SMRs, they need much higher performance fuel.
Okay.
We're talking enrichment levels up to 20%. That's HALEU.
Yeah.
And you just can't build the new reactors without the new fuel.
And on that front, Oklo just hit a critical milestone. They got rapid approval from the Department of Energy for their Nuclear Safety Design Agreement, the NSDA for their Aurora fuel fabrication facility.
And again, it's all about the speed.
Yeah.
That authorization was finalized in just under 2 weeks.
Unbelievable.
The significance here is that the DOE is creating a real, workable, expedited pathway for these demonstration projects. They're shifting the bottleneck away from regulatory complexity and towards, the actual industrial scale-up you need.
And this all ties into that broader DOE reactor pilot program. We keep hearing about this ambitious goal to get at least 3 advanced reactor concepts to criticality by, July 4th, 2026?
That date is extremely ambitious, yes. But it's possible because this fast-tracking uses DOE oversight, which provides a ton of speed compared to the traditionally longer, more exhaustive NRC licensing process.
So the government is accelerating the tech demo, but full commercial deployment still needs full NRC licensing eventually, right? You can't skip the regulator forever.
That is the critical distinction. It's a staged approach. Use the DOE to prove the technology works quickly and safely, like Alatomics is doing as a participant, and then move towards full NRC commercial deployability.
Okay, now let's talk about the major uncertainty that's looming over all of this incredible progress.
The elephant in the room.
The elephant in the room. The success of the entire sector hinges on spent fuel management, and this is widely seen as the highest non-technical systemic risk.
And that risk just went into overdrive. The anti-nuclear group Beyond Nuclear filed a petition for a writ of certiorari with the Supreme Court. The docket number is 25540. This just happened on October 31st.
Okay, let's break down the legal argument here because it's technical, but the ramifications are massive. What are they actually challenging?
They're challenging the NRC's statutory authority, their right to license private consolidated interim storage facilities, or CISFs.
So these are the places meant to hold the waste temporarily.
Exactly. And their whole legal argument hangs on a specific clause in the Nuclear Waste Policy Act, the NWPA. They argue that the law restricts the Department of Energy from taking ownership of spent fuel until a permanent, deep geologic repository is actually licensed.
So they're arguing that the whole current plan, which relies on this interim storage until a permanent site like Yucca Mountain opens, is illegal.
That's their argument, that it's illegal because no permanent repository is operational yet, and that is why this is such a massive problem.
What happens if they win?
If the Supreme Court hears the case and rules against the NRC, it essentially dismantles the entire legal framework for spent fuel management in the U.S. It would just dramatically exacerbate the biggest non-technical barrier to nuclear expansion.
Because all these new reactor projects, especially the SMRs, they depend on having a credible, legal, long-term plan for their waste.
Exactly. It creates instant, massive financial uncertainty.
No private bank is going to loan billions of dollars for a new power plant if the government's plan for the waste might be unconstitutional.
Precisely.
Okay, let's zoom out now and look at the global context. Let's contrast these U.S. efforts, which feel like they're trying to rebuild a fragmented domestic industry, with China's deeply integrated nuclear strategy.
It's a completely different approach. China is vertically integrated. They combine internal tech development with aggressive exporting of their reactors, like the Hualong one, and they secure their upstream resources globally.
Right, like when CNNC bought Namibia's Russing mine back in 2019.
They secured their front-end resource base years ago.
So China controls the resources, the fuel fabrication, and the technology export all at the same time. It's an advantage the U.S. is now scrambling to replicate through policy.
It's a far more seamless approach. I mean, the U.S. strategy of mandates and funding is essential, but it is playing catch-up to a fully operational, integrated national strategy that China has been executing for over a decade.
Speaking of the global future, there's a key industry event coming up this week that really gets to the financial core of this whole thing.
Yes, the OECD NEA workshop in Paris. It's running November 18th to the 20th.
And it's focused specifically on back-end costs for advanced reactors and SMRs. Why is this workshop so important for anyone looking at this space?
Because the variable unknown cost of decommissioning a reactor and dealing with its waste, that is the single greatest commercial barrier preventing widespread private financing of SMRs.
It's the big question mark at the end of the project's life.
It is. If I'm a private investor, I have to know the full cost of ownership.
Yeah.
And if the back-end costs are just a black box, the investment risk is way too high.
So the goal of this workshop is standardization, transparency. They're trying to create guidelines for calculating these costs to make SMRs, well, bankable.
Exactly. Standardization allows for risk modeling. Once you can quantify and standardize those long-term liabilities decommissioning, waste it de-risks the entire investment and moves these technologies closer to attracting large-scale private capital.
So if we synthesize everything we've covered, the price paradox, the policy wins, the systemic risks, where does the industry stand right at this moment?
It is absolutely at an inflection point. The fundamentals are just screaming bullish. You have that chronic 28% structural deficit, the strong contango in the futures market showing deep conviction.
And U.S. policy is finally providing real, actionable support.
Meaningful support through the critical mineral status and that expedited permitting. They are successfully accelerating the front end.
But the future stability of the whole sector really rests on two non-technical things. First, that legal uncertainty around spent fuel, that Supreme Court docket 25540, that has to be resolved.
One way or the other.
One way or the other. And second, that cost transparency on the back end from the NEA workshop, that has to be achieved to unlock the floodgates for private SMR investment.
Which brings us to a final, really compelling question for you to think about. Yeah. The U.S. is aggressively using domestic policy to fund its own supply chain, right? Trying to regain ground.
Right.
But given China's existing fully integrated strategy, where they already control global resources and export the full reactor package simultaneously, what long-term, enduring competitive advantage does that holistic approach hold on the global market, regardless of America's short-term policy wins?
A very different game.
That strategic difference is what's really going to define the next decade of energy geopolitics.
That is a critical piece of the puzzle to mull over. Thank you for diving into the sources with us on The Deep Dive. We'll catch you next time.